At the moment, we're going to focus on the international cost of capital, and in particular the sources of capital and the way you would calculate the firm's cost of capital, or the weighted average cost of capital. And we're going to look at the cost of equity, the cost of debt, and how these would combine together to form an overall cost of capital for a corporation. Alright, so the cost of capital is basically going to be the rate of return that investors require for them to be willing to invest in a company. And in particular, it can be project specific. So it will be the rate of return that would be required to invest in a project of that given level of risk. Importantly here, different projects can have different risk levels. So some projects might be more risky than others and therefore attract a higher cost of capital. So therefore, we're often going to need to do this at a project level as opposed to at a firm level, i.e., you don't just use the one cost of capital for all projects the firm might undertake. Now, usually we're going to start off with the concept of the weighted average cost of capital, otherwise known as WACC. Now, this is going to obviously be at a firm level, but if a project is financed in a slightly different way, i.e. a project mandates that the firm raise more debt or whatever the case might be, then you might use a project-specific weighted average cost of capital, reflecting the capital mix assigned to that subsidiary or to that project. That would also reflect the riskiness of that project, i.e. might reflect the underlying risk level that might have for the firm's equity or for the lenders. Now, the weighted average cost of capital has a few components. It is, unsurprisingly, a weighted average of the cost of the various sources of capital. So to be clear, the cost of capital for any source is the rate of return that an investor requires for them to be willing to invest. So you'll have a cost of capital for equity, which is the return that shareholders would require to invest, and a cost of capital for debt, which is the return that lenders would require for them to be willing to invest. The weighted average cost of capital is the weighted average of those costs, where you're weighting them in proportion to their contribution to the firm's capital structure. So mathematically, WACC is going to have several components. So you'd have the cost of equity multiplied by the weighting of equity, i.e. how much of the capital structure comes from equity, plus the cost of debt multiplied by the weighting coming from debt. Now, this cost of debt is going to be your after-tax cost of debt, i.e. the cost of debt after you've taken account of the impact of taxation and the debt tax shield that can arise. Now, to be clear here, debt and the interest on debt is usually tax deductible, meaning that firms can often use that interest to reduce their taxable income and therefore reduce the amount of tax that's going to be paid. So that cost of debt there is the after-tax cost of debt. The after-tax cost of debt is the pre-tax cost of debt multiplied by 1 minus the tax rate. So we just need to be mindful of that. Sometimes you'll see the formula expressed slightly differently depending on the notation. Just make sure that you're clear about what exactly is going into the formula rather than just blindly using it. Alright, so here we've got our cost of equity and our cost of debt. Now, those things are going to require some further analysis, in particular about how we go about getting those components. We also need to consider how we go about getting the weightings, because the weightings themselves are going to be important, because they're a clear factor that goes into the weighted average cost of capital. So we're going to need to consider those as well. Now, these weightings are generally going to be derived from the market values of equity and the market values of debt. So let's first focus on those weightings. Now, the weightings are generally relatively straightforward. It's effectively going to be the value of your capital structure coming from that component of capital structure. Oftentimes, we're going to simplify it and just assume the capital structure has equity and debt in it. It can obviously have other things like preferred shares, but in general terms, those are relatively small proportions of capital structure. Now, the weightings here are effectively going to be the weighting that goes to that particular source of capital. So, for example, if we're looking at equity, it's going to be the amount of money that's in equity over the amount of the total capital structure, which would be the amount in debt plus the amount in equity, and that's going to be your weighting in equity. Now, similarly for debt. Now, the real questions here are, where exactly does the equity and the debt come from? Now, the equity, of course, is the market capitalization of the company if it's listed. If the company is unlisted, you would ideally get a valuer to value the equity of the company. Now, obviously, that's not going to be very practical in an instantaneous context. So sometimes firms might default back to their book value of equity. But the problem with a book value of equity in general terms is it's quite stale. It isn't telling you what investors currently believe the firm is worth, and therefore it might not give you a good idea about how much money you would get if you were to go out and issue shares right now. So the market capitalization is ideally what you would use. Now, in general terms as well, you would want to use the market value of debt. Now, the market value of debt is useful because that's going to tell you what the market is valuing the firm's debt at. But that obviously is not always doable, because oftentimes with companies, only a proportion of their debt will be in the form of bonds that might be publicly traded. So in general terms, they might have unlisted debt that might not be super easy to value. There are ways to value it, so matrix valuation is a way you can do this. We are effectively looking at the cost of capital or the required return for a given level of debt for this type of firm's riskiness. And you can engineer a valuation for the firm's debt, i.e. an implied valuation. However, it's often going to be not obvious exactly what the market value of debt will be. So oftentimes people will default back to the book value of debt, which is going to be less problematic than, say, the book value of equity, because in general terms, the book value of debt is slightly less stale and is slightly more meaningful than just looking at the book value of equity. Now, importantly here, there's a few things we need to bear in mind. Now, oftentimes, projects will have a similar capital structure to that of the parent, meaning we can often use the weightings that we just do for a parent company. But some projects might have a different capital structure. Now, if they have a different capital structure, then we might need to use a different weighting here. Now, that could be because a project of that level of risk might not be able to support a significant amount of debt, and therefore it might need to use more equity as a proportion of its financing. So we need to bear that in mind and use the relevant weightings that are appropriate for a project of this type. It should also be prospective in nature, i.e. it should reflect the capital structure the firm is targeting towards, as opposed to merely a historical one. Put differently, if the firm is moving toward a capital structure realistically of a given nature, then you would use that target capital structure. Now, that target capital structure would need to be realistic and reachable within a reasonable time frame for you to use it. You wouldn't just use some hypothetical aspirational capital structure, rather it would have to be a realistic target, in which case you would use those weightings, as opposed to merely relying on the historical weightings that the firm might have had. So let's have a look at a really basic example here. So suppose you have a company that's looking at a new investment. The parent company has a debt ratio of 40% here. So 40% of the capital structure is coming from debt. The project, however, can only support a debt ratio of 20%. So let's assume the cost of equity is 12% and the cost of debt is 5% in after-tax terms. To be clear here, I'm assuming after-tax cost of debt. It becomes obviously more complicated when we need to bring in taxation. So this is the after-tax cost of debt in this particular example. Now, what's going to be the weighted average cost of capital here? Well, here, if we're looking specifically at the project, we'd use the weightings that that project can maintain. So we'd use the 20% debt ratio. So in this case, our project's weighted average cost of capital is going to be 20% multiplied by the after-tax cost of debt. And then we need to add on the 80%, which is our debt rating, multiplied by the after-tax cost of debt, multiplied by the cost of equity rather. That's going to give us a weighted average cost of capital in this case of 10.6%, which importantly might be different from the parent company's cost of capital due to the different ability of this project to support debt and equity as compared to the parent firm, i.e. we use the cost of capital that is appropriate for this particular subsidiary as opposed to the overall cost of capital, which might not be appropriate for something of this level of risk. Now, let's focus specifically on the components of the cost of equity, of the cost of capital now. And in particular, our first one is the cost of equity. Now, the cost of equity is basically the rate of return that investors, so shareholders, are going to require for them to be willing to buy shares in this company. Now, there's several ways of proxying it, but the most relevant and useful way is generally through this capital asset pricing model equation. Now, the capital asset pricing model equation basically asserts that the cost of equity is equal to the risk-free rate plus the firm's beta multiplied by a market risk premium. So we've really got three different components here. We've got a risk-free rate, we've got a beta, and we've got a market risk premium. Now, in broad terms, it's basically saying that the rate of return you require on shares is going to be equal to the risk-free rate plus a penalty for how risky this company is. And the risk associated with this firm is basically given to you by its sensitivity to broad market movements. And the underlying assumption here is that investors are broadly diversified and therefore they only care about market risk, because by virtue of diversifying, they're able to eliminate idiosyncratic risk, and therefore they're only exposed to market risk, and therefore it's only the firm's sensitivity and responsiveness to market movements that is going to be relevant here. Hence why the firm's cost of equity is assumed to be the risk-free rate plus its beta multiplied with the risk premium. Now the beta here represents the sensitivity and responsiveness of the firm's returns to the returns on the market index. However, we have a few different issues that arise here. We've got an issue in relation to how do we get beta, also an issue in relation to how do we get the risk-free rate and where is it coming from and what risk-free rate do we use. And then there's an issue in relation to the market index and which market index we might use, because these aren't always obvious issues in an international context. And indeed, it can be the case that it's not clear which market index you use, whether you use the home country one or the foreign country one or a global index. So we're going to look at some of those specific issues for the cost of equity. So firstly, let's talk about beta. Now beta, as I've indicated, represents the sensitivity and responsiveness of the firm's returns to returns on the market index. It's basically telling you the correlation between the returns on the firm and the returns for the market index. Now mathematically, it's expressed here. It's typically obtained by using a regression model, where you regress the firm's returns onto the returns for the market index. From that regression model, which is often called a single index model, you end up with an alpha, which is the intercept for that regression, and the beta, which is the slope in that regression, telling you how sensitive are the returns of the firm to the returns on the market index. Now, usually we'd use this using a regression model. However, that's not always doable. It's not always doable, for example, if you have an unlisted company. If the company is not listed, you don't have a share price, and therefore you don't have a public return that you can run a regression for. It might not also be realistic if the firm is very thinly traded, because if the firm is very illiquid, its share prices and its returns might not be truly representative. So for example, if it's a very small company, and on some days that company doesn't even trade, then for those firms, their return might not be representative of their true correlation with the market, because you simply have days when there's no trading because the firm is so illiquid and unnoticed that you don't get a return. So we've got some issues here. Now I've got a few ways of calculating the beta. Now I mentioned you can calculate it using a regression model, which is relatively straightforward. You can also calculate it using proxy firms or peer firms, which is another way of doing it. And that can particularly be useful if the subsidiary that you're interested in is unlisted. So for example, if you're a multinational and you need to work out the beta for a subsidiary, because if you recall, the cost of equity should be subsidiary specific. If you need to calculate that beta for the subsidiary and the subsidiary is unlisted, you might need to use peer firms to give you an idea of how risky or not that company is, i.e. you'd be deriving the beta from comparable listed firms, this proxy beta, which is often going to entail us needing to use what would be called the Hamada equation. So let's have a think about this. When we're doing this, we're basically saying our subsidiary is going to be comparable to a set of other companies, hence why we can use the beta for these proxy firms. Now, this then begs a couple of questions. Firstly, which firms are comparable? And secondly, regardless of that, how would you even use these betas? Because those comparable companies might have slightly different levels of risk, slightly different levels of financial leverage, slightly different capital structures. So we need to think through how to even use these betas. All right, so focusing on the first issue, which comparable firms? Well, in an ideal world, these would be firms in the same industry, the same level of maturity, roughly the same growth level as the subsidiary you're interested in valuing. They'd ideally be local firms as well, so ideally from the same location as the subsidiary that you're trying to value. Now that's sometimes easier said than done, because it might be that there aren't any local firms in your subsidiary's industry, or there's only one or two of them, or they might not be directly related. So you might need to use firms that are in slightly different industries, but nevertheless are highly correlated. Or you might need to use firms that are in countries that aren't exactly where your subsidiary is going to be based, but are highly correlated countries with very similar risk exposures. So your betas and your comparable firms are going to really need to be dictated by the practical context in which you're doing it. And that's going to be a case-by-case issue, because it's not always going to be the case you have perfectly comparable companies in the location that your subsidiary is going to be in. Now, like I've indicated, they would ideally be local firms. And this is because they would ideally have a similar risk exposure to your project, i.e. they're going to be exposed to similar government policies, similar economic factors, similar industry factors. But of course, that's easier said than done. So that's going to be the first ideal thing. You would also want to obtain multiple proxy firms. The reason you want multiple proxy firms, ideally in the same industry, is different firms might have slightly different factors that might dictate their beta. So some firms might simply have better management structures, and that might factor into their beta. So if that's the case, you need to make sure you can average these out by having enough firms that you're using as proxies. Rather than simply using one, you use multiple firms as your proxy companies. Now that's going to make your beta more accurate and reliable, rather than just having to rely on one firm, which might be somewhat different from your subsidiary in several key ways. So ideally, in short, you'll have multiple comparable firms. In an ideal world, they'll be in the same location as the subsidiary, in the same industry as the subsidiary, and ideally pure play companies. So if your subsidiary does a particular industry, then ideally you would find other listed firms that specifically are in that industry and are pure play companies, which will enable you to calculate a comparable firm's beta. And we'll see how we might go about doing that specifically. So how would you do this? Well, in order to get your subsidiary's beta by using comparable firms, there's a few steps. The first step, of course, is you need to calculate the beta for these other listed companies. That's typically done, as I've indicated before, through a regression model. Now, it's typically done by regressing the firm's returns onto the returns for the market index. So you would use a comparable firm here, and you'd use a regression model, typically done using a single index model. So, for example, you'd have the firm's returns are equal to its alpha plus its beta multiplied by the returns on the market index plus an error term, where that error term represents random factors that can't be captured by your alpha or your beta. Now, the beta from that regression model, i.e. right here, is going to be your comparable firm's beta. Now, you would ideally get that beta for a whole set of firms, as many firms as possible that are relevant in your context. And ideally, you'd be doing this within the local area of your particular firm. Now, you might particularly want to look at, well, which market index is going to be relevant here, because you recall here that to do our regression, we need the firm's returns and we need the market index returns. Now, the question, of course, comes up, which market index do you use? Now, you could use the local market index, or you could use the parent firm's market index. Now, in some cases, you might want to use the parent firm's market index. The reason you might want to use that parent firm's market index is simply because for that parent company, it might be more interested in the risk of that subsidiary with respect to its own market conditions, as opposed to in that foreign market. I might want to look at specifically, well, how does this subsidiary correlate with my parent company's location? Because if you're just going to rebase all of these returns into the parent company's context, then it might be more relevant to look at, well, which country's index is going to be the one that your shareholders are actually concerned about, i.e. you might want to look at the beta for the parent's market index. All right, so that's our first step. You get the beta. Now, in our next step, what we need to do is we need to do a few things. We need to get the capital structure for our comparable firms. Then we need to delever our betas. And then what we need to do is we need to relever the beta using the capital structure of our subsidiary. Those are effectively the steps we need to go through. All right, so we obtained the nominal beta for our comparable firms, i.e. you get that beta from that regression model as our first step. Then what you need to do is you need to delever their betas. Now, to delever their betas, you use what's called the Hamada equation. The Hamada equation basically asserts that the levered beta, which is your market beta that you observe from your regression model, is equal to an unlevered or pure beta, here given a subscript of u, multiplied by an expression representing the capital structure of that firm, which is effectively here 1 plus 1 minus the tax rate multiplied by the debt to equity ratio. Now, the reason it's 1 minus the tax rate is, if you recall, debt is tax deductible, or the interest on debt is tax deductible rather. Now, you'll notice here that your levered beta goes up with the more debt you have, i.e. a more indebted firm is going to have a higher beta than will a less indebted firm. Think of it as being like leverage. When you invest on leverage, you've effectively increased your beta exposure here. So it's the same type of concept here. So you would effectively be delevering your beta. And that's going to give you an unlevered beta for each comparable firm in your set. Now, after you've got this unlevered beta for each comparable firm, you need to calculate the average delevered beta. You could also get the median delevered beta. In an ideal world, you'd probably get both the mean and the median, because then you'd be able to just cross-validate your results. So you get your average or your median delevered beta for all of your comparable companies. So that might give you 10 different ones, and then you get the average and the median of those 10 different comparable firms' betas. Then the next step is you relever them using your subsidiary's proposed capital structure, i.e. you're using the exact same equation, but here your debt to equity ratio is your subsidiary's debt to equity ratio rather than the comparable firm's debt to equity ratio. And that's how you would relever your betas in order for you to obtain a supposed or proxy beta for your company. This is sometimes also called a pure play beta, where you're doing this based on the capital structure of your subsidiary in this case. And you're attempting to get this proxy by using a set of firms that you deem to be comparable to the company or the subsidiary that you're actually interested in. Now, we obviously have some questions here. Which market index do we use as well? Because that's a clear component of our regressions when we're trying to calculate beta. Whether or not you're doing the comparable beta, i.e. this proxy beta, or whether you're doing a beta that's done through just a general regression, we have to decide which market index do we use. Now we can use the parent company's index, we can use the subsidiary's index, i.e. if the subsidiary is in a different country from the parent, then you might use the market index for that subsidiary. So as an example, if you have an American company looking to invest in Australia, then you can use either the American market index or the Australian market index to calculate your betas. Or alternatively, you can use a global index like the MSCI index, which is going to hypothetically track a global index of stocks. You have several options here. Now the question is, which of these would you use? Now, if we really believe the market is globally integrated, then you would use this global index. Now, to some extent, the market indexes are becoming more and more globally integrated. Increasingly, investors are investing in multiple different countries. So while you and I might not specifically directly invest in those indexes, we might get exposure. We might get exposure through our super funds, which often have a global stock allocation, or we might get exposure through, say, contracts for difference or other derivatives, where we might not directly invest in those overseas stocks, but we might invest in a derivative on those overseas stocks. So we indirectly have an exposure here. So to some extent, global markets are becoming increasingly integrated. The global index is going to become more and more relevant over time. Now, as to whether the MSCI Global Index is actually a useful proxy, that's another issue entirely. But theoretically, a global index is becoming increasingly relevant, at least for a specific set of stock markets that are becoming increasingly globally interlinked. Now, if you'll see, every time the US stock market moves, many other developed market stock markets move in response as well. So it's important to bear in mind there is a significant correlation between many of these linked markets. We could use the parent company's index. Now, in general, we might want to do this when doing our regression. Now, part of the reason for this is our shareholders for our parent company are often most interested in how correlated are the returns of their subsidiary to their market index that they're most exposed to. In particular, if you've got an American investor in an American parent company, they're going to be most interested in how that subsidiary is correlated to the parent company's other returns. So in that case, you might use a beta with respect to the parent company's index. You could hypothetically use the local index as well, but that's generally going to be less relevant, and generally more relevant if you're treating these subsidiaries as very separate entities, i.e. if you're treating the subsidiary as being its own separate individual entity without being necessarily consolidated, then using the local market index might be more relevant in that context. So we can then move on to the cost of debt. Now, the cost of debt is basically the rate of return that lenders require for them to be willing to lend to your company, i.e. what's the yield to maturity on debt. Importantly here, it is the yield to maturity on debt instruments, not just the interest rate on existing debt instruments. The interest rate on existing debt instruments is often historical. It might represent the risk level of that company when it went out and borrowed. It might reflect the market conditions at the time the firm borrowed. So, for example, during the 2020 issues, we've had reductions in the government interest rate, which is going to result in the interest rate that's being assigned to these companies as being lower than historical. So you're going to need to look at this based on the yield to maturity on the debt the firm might issue, i.e. is the cost of debt that's demanded for something of this level of risk. Importantly, it's tied to the risk level that might arise. Now, companies can borrow either in the parent's market or in the subsidiary's market. Now, there are factors to bear in mind here. You might want to borrow in the market that is hypothetically cheaper to you. Now, depending on whether you believe interest rate parity holds, the Depends on whether you think it's relevant and beneficial to borrow in the cheaper market. However, you might still borrow in the subsidiaries market if, for example, you want to match up your revenues with your expenses, in which case it can be quite beneficial to borrow in the market where your revenues are going to be coming in. So foreign exchange risk can be a factor that is going to dictate where you ultimately end up borrowing. And you might need to consider the exchange rate appreciation and depreciation or expectations thereof when assessing which market might be the more expensive or less expensive to borrow in. In short, the cost of debt is going to reflect the rate of return that lenders require to invest in this subsidiary through debt and through lending, and is going to need to depend on where you're borrowing to some extent as well. So let's have a look at an example. So suppose you run ABC, which is an Australian company. You can borrow in Australia at 5% or the US at 3%. The question is, should you borrow in which of these markets? And should you necessarily just borrow in the cheaper market? Now, the answer is that you would probably borrow in Australian dollars. The reason you'd probably borrow in Australian dollars is that's probably where your revenues are coming in. And therefore, it will reduce your foreign exchange risk if you're able to match up your revenues with your expenses. Now, one could look at this and think, well, maybe we should borrow in the cheaper market. Whether this is actually useful is really going to depend on interest rate parity to some extent. Now, if you believe that covered interest rate parity holds to some extent, then you probably won't necessarily want to borrow in the cheaper market because exchange rates are going to fluctuate to reflect those interest rate differentials. And in equilibrium, we've got this Fisher equation, which basically asserts that the nominal interest rate is going to be equal to 1 plus our real rate multiplied by 1 plus our inflation rate. So basically, if we've got a situation here where we've got an inflation rate differential and interest rate differential, those are effectively going to even out over time, and you're going to end up with a situation where it's not necessarily going to benefit you borrowing in the cheaper market here. I.e., you might just go out and borrow in the market that is going to reduce your foreign exchange exposure and your foreign exchange risk. So we need to look as well at the cost of these borrowings. So we can look at, well, what is the ex post cost of borrowing in a given exchange? Well, the ex post cost of borrowing is going to be a function of two things, the interest cost and the exchange rate cost. And we can express this as follows. The percent cost of a local loan is going to be the interest cost multiplied by 1 plus the change in the currency plus the currency change. Effectively, what we've got here is we're basically multiplying through our interest rate cost with our currency change cost. Now, we can think about this as having two components. In our first component here, this is the impact of our interest rate cost after we've taken into account currency changes. It's basically saying we've got our interest cost, then we need to either increase it or decrease it based on the currency change. Then we're adding on also our currency change as our cost. That's effectively how we're calculating it. So we get our nominal interest rate we're paying on our debt, multiplied by 1 plus the change in the currency, and then we add on the change in the currency to get our overall cost in local terms from this loan. So as an example, suppose we have a US multinational and is borrowing in euros, and is borrowing 10 million euros for 1 year at an interest rate of 7%. The current exchange rate is 1 euro is 1.47 US. In 1 year, the exchange rate is 1 euro is 1.41 US. So what that means is the euro has basically depreciated. So we can have a look at, well, what's been our effective cost here. So we can see how we get our effective cost of debt. So let's first look at our first way of getting this. So the first way of getting this is we acknowledge that our interest rate is 7%. So this means that if we borrow 10 million euros, we're going to need to repay 10.7 million euros, i.e. 10 million multiplied by 1.07. Now, in US dollar terms at the very beginning, our 10 million euro loan is 10 multiplied by 1.47 equals 14.7 million US dollars. That's basically coming from taking a loan amount multiplied by the exchange rate equals the US dollar value of our loan. Now let's look at the US dollar value of our repayment. We're repaying at the very end, and we're repaying 10.7 million euros. But the exchange rate at that time is 1.41. So therefore our repayment is $15.087 million. So we can look at, well, what's our effective interest rate? To get our effective interest rate, we get 15.087 divided through by 14.7, and that's going to give us our effective interest rate of 2.63% here. I.e., because the euro has gone down in value, the debt is actually cheaper for us to repay. That's because of the currency depreciation of the euro. So that's our first way of going about looking at it. The second way is we can kind of use this formula. So to use this formula, we need to first look at, well, what's been the change in the euro? The change in the euro in percentage terms is 1.41 minus 1.47 all divided by 1.47. Put differently, you're just looking at the percentage change in how many dollars a euro is going to buy you. So that's going to be the C part of our equation here. The R part is 7%. So what we then effectively have here is we've got the 7% multiplied by 1 minus 4.08%, which is the depreciation of the euro, minus 4.08%, again the depreciation of the euro. So our effective cost, again, is 2.63%. In either case, the debt ends up being cheaper because the euro has depreciated here, meaning that we need to calculate and take into account both the interest rate effect of our debt, but also the exchange rate effect and the impact that that has on our cost of debt in an ex post sense. Now, what do we do if there's taxes? Well, if there's taxes, we also need to consider the impact of tax as an after-tax cost of debt. Now, this is really simple to do. Basically, what you do is you take the formula from before, where you have our interest rate here, we multiply it by 1 minus the tax rate. The reason we multiply it by 1 minus the tax rate is because the interest is tax deductible. Hence why, to get the after-tax cost of debt, it's R multiplied by 1 minus T here. Now, in this formula, we've still taken into account the change in the currency here, but we're focusing on the after-tax implications here. Now, the tax rate here is the relevant marginal tax rate that is going to apply to that particular set of payments. Now, that's going to really depend upon which tax regime and which jurisdiction those repayments are occurring in. Whether it's the parent's regime or the subsidiary's regime, you're looking at it based on the tax rate that is going to apply to these particular interest payments. So it's important to make sure you're using the appropriate jurisdiction for that tax rate. So let's have a look here. So suppose we've got a 1-year interest rate on US loans is 10%. The 1-year interest rate on Japanese loans is 5%. Now the question is, does this present a riskless strategy for us to get low interest rates? Now the clear answer to this is no, it doesn't. The reason for that is there's still forex risk, and the exchange rates are likely to depreciate or appreciate as is relevant to reflect those interest rate differentials. Now the next portion is, suppose there's a current exchange rate rather, of 1 US is equal to 140 yen. What is the lowest future exchange rate at which borrowing in yen is no more expensive than borrowing in US dollars? So we can think about this as follows. To find the break-even exchange rate, we need to take our S1 here. Now S1 here is basically representing the amount of dollars. Multiply that by 1 plus the US interest rate, has to be equal to 140 being the exchange rate, multiplied by 1.05 being the yen interest rate. S is going to represent our break-even exchange rate. So we just will get that through multiplying and dividing through. Another question is, suppose we're the manager of an English subsidiary of a US firm, trying to decide whether to borrow for 1 year in dollars at 7.8% rather, or in pounds at 12%. The current value of the pound is $1.7 dollars per pound. At what year-end exchange rate would the firm be indifferent between borrowing in pounds and borrowing in dollars? So let's have a look at this. Now to do this calculation, we need to recall that the ultimate cost is equal to the interest rate we'd pay multiplied by 1 plus the change in the currency plus the change in the currency. Now we can rearrange this and we can solve for C, which is the percentage change in the currency. Now this is just rearranging the whole formula and solving for C. Basically group up everything that would have C as a pronumeral and then divide through as is relevant. This is ultimately going to result in R here being the interest rate that we wanted to solve for, minus the other interest rate, divided through by the interest rate, or 1 plus the interest rate rather. So say we're sitting or trying to work out, well, what currency change is going to make us indifferent between borrowing in pounds and the US? Our RU here is going to be 7.8%. So we'll get 7.8% minus 12% divided by 1.12. So that's going to mean our change in our currency has to be a depreciation of 3.75% for us to be indifferent between the two borrowings, i.e. the pound has to depreciate by 3.75%. depreciating from $1.7 per pound. Alright, so this is a basic summary of the cost of capital, the weighted average cost of capital, and the components that go into it. In particular, we've looked at the cost of equity and the cost of debt, and we've also looked at the weightings that would go into the weighted average cost of capital. And in brief, we've basically asserted that when you're looking at the weighted average cost of capital, you have to look at the weightings that would be relevant for the subsidiary, and also the costs of capital that are relevant to a subsidiary of this level of risk. We've looked at the cost of equity and how you might obtain that by looking at comparable companies, and we've looked at the cost of debt and how you might also obtain that, but also in terms of that cost of debt, how it's relevant to look at the impact of currency changes when we're looking at the ex post or after the fact cost of debt that the firm implicitly actually bears.